Current market status. Closed. The last trading session for Bitfarms Ltd ended with the stock priced at exactly 3.42 Canadian dollars, representing a sharp decline of 0.23 cents or 6.30% for the day. When you see a drop of over 6% in a single session, the immediate assumption, the expectation most retail traders have, is that the price of Bitcoin itself must have collapsed. Or perhaps the company released a catastrophic earnings report that signaled the end of the road. You check your Robinhood app or your Fidelity mobile app and you see the red numbers, and the panic sets in because the correlation between the coin and the miner feels absolute. But the reality here is far more nuanced and, frankly, more interesting than a simple sympathy play with the crypto markets. While Bitcoin price action certainly dictates the gravity of the sector, Bitfarms is currently entangled in a unique corporate warfare scenario that makes its chart behave differently than its peers. The drop to 3.42 CAD isn't just about the spot price of digital currency. It is a reflection of the market digesting the complex standstill agreement with Riot Platforms and the confusing signal sent by their recent Q3 2025 financial results, which showed massive revenue growth paired with widening net losses. This tension between a company that is operationally exploding in size, yet financially bleeding on paper, is what creates the opportunity and the danger we are looking at today. Let's break down this specific intraday movement and the broader week's performance, because the volatility here is telling a story that interactive brokers' trading algorithms are picking up on, even if the average retail investor is missing it. The stock opened the session under pressure and never really found a footing, sliding consistently throughout the day to close near the lows. This kind of price action, where buyers failed to step in at intraday support levels, usually signals institutional exhaustion or a risk-off approach leading into the weekend. Investors using Schwab Intelligent Portfolios or similar automated risk management tools might see this high beta asset getting trimmed from portfolios as volatility metrics spike. But why the sell-off now? The answer lies in the discrepancy between operational hash rate and financial bottom line. Bitfarms recently reported revenue of $69 million, up a staggering 156% year over year, yet they posted a net loss of $46 million. This creates a cognitive dissonance for the market. You have a company that is mining more Bitcoin than ever, expanding its fleet with aggressive efficiency, yet the costs of depreciation and the sheer expense of expanding power infrastructure are eating the profits alive. The market is trying to figure out if Bitfarms is a growth stock or a value trap, and that indecision manifests as a 6.30% red candle on your screen. We need to address the elephant in the room, which is the Riot Platforms saga. This has been the dominant narrative for months, and it completely distorts the technical analysis. Typically, when you analyze a stock like Tesla stock or Apple stock, you look at product demand and supply chains. With Bitfarms, you have to look at a hostile takeover defense. Riot Platforms, a massive competitor, holds roughly 19.9% of Bitfarms. They wanted to buy the whole company. Bitfarms' board fought back, adopting a poison pill strategy to dilute shares if Riot tried to cross a certain ownership threshold without approval. They eventually reached a settlement, a standstill agreement, where Riot agreed not to acquire more than 20% of the stock until the 2026 annual meeting, effectively putting a ceiling on the takeover speculation that had been propping up the price. This is critical to understand. A lot of the buying pressure earlier in the year was arbitrage traders betting on a buyout premium. Now that the buyout is essentially paused or iced, that speculative capital is leaving the building, causing the stock to drift lower to its organic fair value. When you use investing sites or read forums, you will see people screaming about manipulation, but this is just the mechanics of merger arbitrage unwinding. The premium is gone, and now the stock has to stand on its own 2 feet. This brings us to the operational reality of what Bitfarms actually does. For those who might be new to online investing or are looking for investment help regarding the crypto sector, Bitfarms is a vertically integrated Bitcoin miner. Unlike a company that designs chips like NVIDIA, Bitfarms runs massive data centers, warehouses filled with specialized computers called ASICs that perform complex mathematical calculations to secure the Bitcoin network. In exchange for this energy-intensive work, they earn new Bitcoin. It sounds simple, but it is a brutal business of scale and efficiency. You're essentially selling electricity to the blockchain. Bitfarms distinguishes itself by focusing on green energy, utilizing hydroelectric power in places like Quebec, Washington State, and Paraguay to keep their costs low and their environmental footprint smaller than competitors who rely on coal or natural gas. They have been aggressively upgrading their fleet to the latest T21 miners, aiming for an efficiency of around 21 joules per terahash. In plain English, this means they are trying to squeeze more computing power out of every watt of electricity they pay for. This is the only way to survive in a post-halving world where the block reward, the amount of Bitcoin given to miners, has been cut in half. But the sheer capital required to maintain this fleet is astronomical. This is where the difference between self-investing in a miner versus holding the coin becomes apparent. When you hold Bitcoin, you have no overhead. When you hold Bitfarms, you are holding a company that has to constantly spend millions of dollars on new hardware just to stay in the same place. This is known as difficulty adjustment. As more powerful machines come online globally, the network becomes harder to mine. If Bitfarms doesn't upgrade their fleet, their slice of the pie shrinks. This week's price action suggests the market is worried that Bitfarms is spending too much capital to chase this hash rate. The $46 million net loss reported in Q3 2025 included significant non-cash depreciation, which makes the earnings look worse than the cash flow situation, but it still scares away the conservative capital. Users of Fidelity Wealth Management Services or those with conservative Fidelity IRAs are rarely advised to touch small-cap miners for this exact reason. The capital depreciation is relentless. Let's look closer at the technicals because the chart is painting a very specific picture right now. The 3.42 CAD level is precarious. We are seeing a Death Star signal on some longer-term moving average crossovers, which is a bearish indicator suggesting that momentum has decisively shifted to the downside. The stock is trading below its 50-day and 200-day moving averages, a classic sign of a downtrend. Technical support is thin here. If you look at the volume profiles available on a Fidelity trading platform or Interactive Brokers trading platform, you will see a volume gap below 3.00 CAD. If 3.20 breaks, we could see a flush down to the 2.50 CAD level, which corresponds to historical support from late 2024. On the upside, resistance is heavy at 4.00 CAD. There are a lot of bag holders. Investors who bought the hype during the Riot takeover rumors are stuck at that 4 to 4.50 level. As soon as the price rallies back to 4 CAD, these people tend to sell to break even, creating a wall of supply that is hard to break through. This is why the stock feels heavy, even on days when Bitcoin is green. This is the part where you have to ask yourself a hard question about your portfolio strategy. Comment below how many shares of Bitfarms you currently hold and what your average entry price is. Are you holding because you believe in the company's efficiency, or are you just hoping for another buyout offer from Riot? It is important to be honest about your thesis. Expanding on the institutional landscape, we have to consider how the big players are positioning. Institutional ownership in Bitfarms has been fluctuating. While Riot is the largest holder, we also see activity from major ETFs and index funds. When Fidelity ETFs or SoFi ETFs rebalance, they buy or sell millions of shares regardless of the daily news. The recent drop might also be exacerbated by tax loss harvesting. Since we are approaching the end of 2025, funds that are sitting on losses in Bitfarms might be selling now to offset gains elsewhere, driving the price down artificially. This is a common phenomenon in the small-cap crypto mining sector. Smart retail investors who use individual brokerage accounts can sometimes take advantage of this by buying when the tax selling reaches its peak, usually in mid-December, but catching a falling knife is dangerous. You need to be watching the hash price, the revenue a miner earns per terahash. If hash price is falling, no amount of chart analysis will save the stock. Currently, hash price is under pressure because the global hash rate is at all-time highs. Everyone is plugging in machines, which dilutes the profit for everyone else. Let's talk about the geographical risk, which is often overlooked by people new to invest online. Bitfarms operates heavily in Latin America, specifically Argentina and Paraguay. While this offers cheap power, it introduces political and regulatory risk. The economic situation in Argentina is volatile.